Okay, let's dive into this latest stack of global maritime reports.
Hmm.
We've got sources covering, well, everything from these huge ship sales, multi-million-dollar deals,
Hmm.
to some pretty unprecedented financial restructuring and even high-stakes international legal battles.
Wait.
So our mission today, really, is to try and make sense of this, synthesize the data, and we need to focus on these core paradoxes. Why are asset values soaring while freight rates are collapsing?
Yeah.
And how's all this geopolitical pressure forcing these fundamental changes in, like, corporate ownership?
Well, what's really fascinating, I think, is just the sheer speed of it all, the speed of change and the high stakes games being played.
Right.
You see owners clearly capitalizing on what might be peak prices for their ships.
Making hay while the sun shines, basically.
Exactly. While at the same time, these key global freight indices, they're flashing some serious warnings. It shows this huge disconnect, doesn't it, between the physical steel value of the ship and what it actually earns carrying cargo right now.
Let's get right into that contradiction then. This market schizophrenia, as you might call it. So owners are definitely maximizing fleet value. Take Oslo-listed 2020 bulkers.
Okay.
They sold half their Newcastle Max fleet. Those are the really big dry bulk carriers, right? Built for specific ports.
The giants.
Sold them for $209 million.
Mm.
And they're expecting, get this, a net book gain of $89 million from that one deal.
Wow. That's not just selling assets. That's serious wealth creation right there.
Absolutely.
And it's not just them. You see German owner Elbdive Reederei doing similar optimization, selling ships. And Greek owner Conships, they just sold the Conship Oak to MSC for, what, $11.5 million?
Okay.
And it seems like a very calculated move. Conships specifically said they're avoiding the new building rush. Shipyard prices are just too high. Capacity's tight.
So sell high, but don't necessarily buy back in immediately, especially not new ships.
Precisely. Avoid that construction frenzy.
Right. Sell high. But then look at the other side, the price to actually move goods. It's sinking fast. Drewry's World Container Index, it's down another 8% just this week,
Yeah, saw that.
down to $1,761 per 40-foot container, the FEU. That's the 15th week in a row it's dropped,
15 weeks.
hitting the lowest levels we've seen since the whole Red Sea crisis started messing things up. It's a genuinely weak demand signal, isn't it?
It really is, and that leads to this kind of weird operational situation, disruption actually helping.
How so?
Well, Super Typhoon Wagasa, major storm, caused delays up to a week at Yantian port in China.
Okay, big port.
Huge port.
Yeah.
And some analysts are suggesting that this forced congestion, plus carriers blanking more sailings, canceling trips, might actually paradoxically help put a floor under those sliding spot rates, at least temporarily.
Sounds like a pretty shaky strategy long term, relying on actual typhoons to prop up your rates.
Yeah.
Does that suggest the fundamental oversupply in containers is maybe worse than carriers are letting on?
It certainly raises that question, doesn't it, about the underlying supply-demand balance. But the, let's say, unconventional maneuvers, they don't stop there. We should probably shift to the geopolitical side, starting with this U.S.-China financial situation.
Ah, yes, this is complex. The attempt to sort of restructure ownership. Chinese bank leasing arms are talking urgently with Beijing's regulator.
That's right, talking about converting existing shipping leases into secured mortgages. Now, that's a very unusual shift for a bank's shipping book. Very unusual.
Why do it? What's the driver?
It looks highly deliberate. It seems to be a direct safeguard against those upcoming U.S. levies, the ones targeting Chinese-built and operated ships docking in the U.S. starting October 14th.
Right, the new fees.
Yeah, so the U.S. rules seem to target foreign operational control via leases. By shifting to a mortgage, the Chinese banks become the primary secured lender, not the operational lessor. It changes the asset classification, potentially bypassing those fees.
So a big financial workaround, basically, a defensive strategy.
A large-scale one, yeah. And then you also see this linkage, military and energy trade, right at the top level.
A Trump suggestion about Turkey.
Exactly. Suggesting lifting U.S. sanctions so Turkey can buy American F-35 jets.
Right.
But only if Ankara stops buying Russian oil.
Yeah.
It's significant because it directly fuses military sales with energy sanctions. A single negotiation point. Could be a new template, maybe?
Interesting. High-level horse trading. And then there's this legal drama. This is where it gets really interesting, I think. The alter ego case.
Oh, absolutely. A Marshall Islands court just handed down a really powerful ruling, allowing a Canadian firm, Third Eye Capital, to go after the personal assets of Parakou Tankers owner, Poor Lou.
To satisfy a $10.65 million arbitration award.
Correct.
So they basically pierced the corporate veil.
Hmm.
The judge decided Lou was the company, the alter ego, and ran it to defraud creditors.
It completely upends the traditional idea of limited liability for corporations in that context, a huge decision.
So if we try to tie all this together,
Hmm.
what's the bigger picture?
Well, it feels like the nature of risk itself is shifting, being transferred around. You see financial risk moving from lessors to secured banks in China,
Okay.
operational risk, like those typhoon delays, maybe being used strategically by carriers.
Right.
And now, personal risk,
Yeah.
being hammered home against owners through legal rulings like this alter ego one.
So for you listening, what does this all mean? We've seen owners making these massive $89 million gains while the actual cost of shipping stuff globally is plunging,
Hmm.
all happening against this backdrop of really complex international trade friction, forcing companies to change shape or, well, face the consequences.
Which brings us to, I think, a really important question to ponder. Does this alter ego ruling in the Marshall Islands, and remember, that's a key place for global maritime law and finance.
Crucial jurisdiction.
Does this signal a major, maybe irreversible global trend? Are we going to see corporate owners held personally accountable more often in these big international finance disputes? Is that corporate veil actually getting thinner everywhere? Because if it is, the whole calculation for every ship owner, every investor, it's just fundamentally changed.